Japan has joichisuppin regional banks. Most of them are losing money. Not dramatically, no bank runs, no emergency bailouts, just quietly, slowly, lending into a shrinking economy at rates too low to matter, sitting on bond portfolios that lose value every time the central bank does what central banks are supposed to do. For 30 years the math looked fine because interest rates were zero. Now that they're not, the math looks very different.
This is the story of how Japan built a banking system for a country that no longer exists. At its peak in the 1980s, Japan's economy was growing faster than its infrastructure could keep up. Companies were expanding, factories were moving into second and third-tier cities, and every rural prefecture needed capital to fund local business. So Japan built banks, lots of them.
Today Japan has Ryushiji first-tier regional banks, Sansulik second-tier regional banks, and roughly 44 Shinkin banks, cooperative institutions serving small businesses and individuals within defined geographic areas. For comparison, the entire United Kingdom runs on 5 major banks. Japan has nearly 4 distinct regional institutions, most of them confined to a single prefecture, many of them serving populations that have been falling for 2 decades.
The census released last month confirmed what demographers had been predicting. Japan's population fell to 4 million, down 3 million in 5 years, the sharpest decline on record. Of Japan's 30 prefectures, 30 shrank. Only Tokyo and Okinawa grew. In Akita, the most extreme case, the population is falling at almost 9% per year. By census, the prefecture is projected to have 30% fewer residents than it does today.
A bank that exists to serve Akita is by extension serving a client base that is structurally disappearing. For most of the last 30 years, Japan's regional banks had a lifeline that papered over this problem, the bond carry.
Here's how it worked. Deposits flood into a regional bank from local businesses and households. The bank needs somewhere to put that money. Rather than fighting over a shrinking pool of local borrowers, the bank buys Japanese government bonds, JGBs. The Bank of Japan, holding rates at 0 or below since the late 1990s, kept those bonds stable in value. The bank collected the yield, paid depositors almost nothing, and called the difference profit.
It was a business model built on negative interest rates, and it worked until the Bank of Japan decided it shouldn't.
In March, the BOJ hiked rates for the first time since ending years of negative territory. By December, the policy rate reached 0.25%, the highest since Senjubak Jushuuden. For most economies, that's still historically low. For Japan's regional banks, it was an earthquake.
When rates rise, bond prices fall. The unrealized losses on domestic bond holdings at Japan's regional banks surged to a record $4 billion as of September 50 WOV ors Lucas % increase from where they stood when the BOJ made its first move 18 months earlier. The banks haven't realized these losses yet, but they sit on the balance sheet as a warning. Capital ratios tighten, flexibility disappears.
There's a second pressure. Rate hikes eventually help net interest margins, the spread between what a bank earns on loans and what it pays depositors. But the timing is asymmetric. Banks raise deposit rates almost immediately. Loan repricing takes years, especially in regional markets where competition is fierce and borrowers can push back. According to S&P Global's Japan Banking Outlook for Nisen years of the tailwind from rate normalization is real, but regional banks benefit significantly less than the megabanks because rural loan markets are too competitive to pass costs through.
Rising rates are supposed to cure what ails regional banks. They're doing it, but slowly, while inflicting short-term pain that some of the weaker institutions may not survive.
Into this environment walks SBI Holdings, Japan's largest online brokerage, with an unusual ambition to become the country's fourth major banking group.
SBI's strategy is not to start a bank, it's to buy stakes in failing ones. Since Nissan SBI has acquired equity positions in 9 regional banks, most in the range of SAN to T4%, small enough to avoid triggering full acquisition rules, large enough to plant a board member, install SBI's proprietary core banking software, and start cross-selling securities and insurance products to the bank's existing customers. The pitch to struggling regional banks is essentially, we won't take you over, we'll make you cheaper to operate.
The digital infrastructure piece matters more than it sounds. Regional banks run on legacy core banking systems that can cost hundreds of millions of yen per year to maintain. SBI's shared platform, deployed across its partner network, dramatically reduces those costs. A bank in Shimane with gourmand customers probably cannot afford to build modern digital banking on its own. Plugged into SBI's network, it might not need to.
SBI's Q2 2025 revenue grew 34% year-on-year to 443.2 billion, driven in part by the banking segment expansion. But the real test is still ahead. Whether a distributed network of minority stakes in distressed regional banks constitutes a fourth megabank, or just a collection of slowly sinking ships with matching hull paint, remains an open question.
The government has been trying to solve this problem through mergers, with mixed results. In Arthur, the Japan Fair Trade Commission relaxed its antimonopoly rules specifically to allow regional bank consolidation within prefectures, a window that remains open until Misen Sanshiten. The Ministry of Finance began offering subsidies of up to yen billion, roughly $60 million, for merging banks. The Financial Services Agency has been openly encouraging deals, with its chief on record saying the agency will support consolidations that contribute to high-quality regional financial services. An extension of these special measures is currently under discussion.
The mergers are happening. In Ursawu, Aomori Bank and Michinoku Bank completed the first ever merger of 2 major regional banks within a single prefecture. The new Aomori Michinoku Bank now controls approximately 80% of the local credit market. For a prefectural capital that lost 89% of its population in Ursa alone, it may have been the only viable path.
The Daishi Hokuetsu Financial Group and Gunma Bank announced their integration in April, Hasamuryo, with a deal to close in April, Hasamuryo Yasishisidian. The combined entity, to be headquartered in Tokyo, will carry Hasamuryo and trillion in assets and become Japan's 5th largest regional bank group by scale.
These are not small moves, but they raise a harder question: does consolidation solve the problem, or just slow the decline?
When 2 banks merge, branches close. Branch closures in rural Japan are not merely inconvenient, they represent the removal of financial infrastructure from communities that often have no alternative. According to research published in the Journal of Financial Economics, Japan's branch and ATM consolidations have measurably reduced cash access for elderly and lower-income customers. In rural prefectures already losing population at nearly 9% annually, a closed bank branch is one more reason for the next generation not to stay.
A single dominant bank controlling 80% of a market can price its loans however it wants. In a growing economy, market concentration creates efficiency. In a shrinking one, it can accelerate the death spiral. Fewer branches mean less economic activity. Less economic activity means fewer viable borrowers. Fewer viable borrowers mean a bank with no reason to stay.
The Japan factor in this story is not about banks, it's about what banks represent. Japan's regional banks are the financial plumbing of rural Japan, not glamorous, largely invisible to the outside world, but the infrastructure through which capital flows to local businesses, local governments, and local households. The quiet consolidation of that infrastructure is the clearest evidence of something that Japan's largest cities still haven't fully felt: the demographic reckoning.
Tokyo grew in the last census. Tokyo is fine, but Tokyo is not Japan. Japan is also Akita, losing 9% of its people every year. Japan is also Hokkaido, which shed Nishusanman Kyusen residents in 5 years. Japan is the Sonjurwo prefectures that shrank, the rural towns where the only branch of the only bank is scheduled to close next year.
For those communities, the bank merger isn't a financial story, it's a story about whether anyone is still betting on their future.
The BOJ's rate hikes will eventually improve regional bank margins. SBI's technology platform will eventually reduce costs. The FSA's consolidation incentives will eventually thin the herd to something sustainable, but none of these interventions address the fundamental constraint a banking system built for a growing dispersed economy is being asked to service a contracting concentrating one. The tools available, rate policy, regulatory flexibility, merger incentives can reshape the institutions. They cannot reshape the population.
There will probably be Sorsha or Wolfsha regional banks in Japan in 20 years instead of Q17s. The question no one has answered yet is which communities will still have a bank when the consolidation is finished.
If you want to keep up with stories like this, subscribe to the Japan Factor. Japan's demographic reckoning is not coming. For most of Japan, it's already here. It's just happening quietly, one branch closure at a time.